Welcome back to Crypto Saver. Today, the topic that I want to discuss with you guys is insurance within the DeFi space. Because as DeFi continues to grow, as there's more attention to it, as there's more projects coming out, some people, some traders, investors, people looking to save their money, grow their money, are asking themselves, can there actually be insurance for DeFi? Because if there is insurance for DeFi, I'm willing to put more of my savings into it. So in this video, I kind of want to discuss it. I want to discuss whether or not insurance even makes sense and whether or not it is something that we can actually rely on. Even though there's this belief that insurance companies are this bottomless pit of money, and that no matter what, if you put a claim in, they have to fulfill that claim, that they have the money for that claim, that's not really the case. And that's what we're here to discuss. I think we should begin of just going over how insurance companies typically work, or at the very least, how they work to remain solvent. If we take car insurance, for example, the reason people get why do people get car insurance? People get car insurance because they cannot afford to possibly pay a bill for $10,000, a repair bill that comes up 2 or 3 months from now in case they get into an accident. But people can afford to pay $100, $200 per month into it, with the belief that, hey, if I do get into this big accident, the insurance company is going to be covering it. Just typically what happens. The insurance companies find this arrangement because they understand not everybody's going to draw on their policy. There are some drivers out there who may drive for years and be a client of that insurance company and never have to draw on their policy. The insurance company is able to pocket that money and use some of that money to help pay on other claims from other clients. I like to view it as most insurance companies deal with staggered claims. Staggered in the sense that they don't get this huge eruption of claims in one shot. It's usually, if we take a company like Allstate, they probably have tens of thousands of claims per day, but that's fine for them. That's staggering. If all of a sudden there were 20 million claims in a single day, that's a completely different issue. And typically, with insurance companies, when there's so many claims within a small amount of period, it very likely leads to insolvency. And two examples I kind of want to look at would be what happened in '08 with AIG. AIG was an enormous insurance company for financial products worth billions of dollars on their balance sheet, but they went bankrupt. Why did they go bankrupt? They went bankrupt because they were offering insurance on mortgage backed securities. Well, we know what happened back then. The whole industry, the bottom of the whole industry fell out. So people that thought that, wait a minute, investors, they're like, I can buy these mortgage-backed securities and do these credit swaps and insure them, and there's very little risk. Well, the risk is in the sense that when the bottom falls out and there's a systematic risk to everything, nobody's getting paid out because the insurance company cannot afford to pay out on all these claims within a short amount of period. There are insurance companies next in New Orleans, right? When the hurricane came through, Hurricane Katrina, same situation. There are just so many claims coming in. The insurance company cannot afford to pay all that. Insurance companies typically stay solvent when the claims can continue to be staggered. Another point that I kind of want to refute would be the margins when it comes to insurance companies. If we just look at the financial statements, of typical insurance companies, the biggest ones, let's say in the US, the profit margins are very, very slim. It's a very tough business to be in. End of the day, they're hoping that they can just eke out a small amount of profit because it's also very cutthroat. There's a lot of competition, but also the fact that people constantly do get into accidents. People do have their stuff stolen, right? If you have homeowners insurance, there's flooding. So a lot of things happen. So the insurance industry as a whole, it's very tight margined. And when we look at insurance within crypto right now, it's becoming a bit more prevalent. So the one I want to look at specifically would be the ones being offered for the Anchor protocol. For those of you that do not know, Anchor is a project on the Terra block system. You deposit your money with Anchor, and they promise you a 19.5% APY. That sounds fantastic. People love it so much that we're asking, hey, will there be insurance providers for Anchor? And yes, now there are insurance providers for Anchor. But let's look a little closer at that. There's two insurance companies right now offering protection on Anchor. One of them is offering smart contract risk, and the other one is offering depegging risk. Anchor uses the stablecoin, the main stablecoin for Terra, which is USDT. That's the main stablecoin. So people want to get insured against the stablecoin, and people want to be insured against the contract risk. Now, the reason why the stablecoin is a little bit iffy is because Terra's stablecoin, this USDT, is not a reserve stablecoin. It is not held. There's not a dollar in the vault for every dollar of USDT that is minted. Instead, it uses an algorithm between another token called Luna to kind of try to keep itself pegged at a dollar. Now, there's a risk there because we do not yet know how these stablecoins that are based on algorithms are going to function moving forward. But let's think about this for a second. If there is smart contract risk on Anchor, if there is depegging risk on USDT, would the claims be staggered? Would they come in slowly over a longer period of time? Not really. If there are 1,000 people out there that go and get an insurance for USDT on pegging and USDT on pegs, then guess what? Every single person that has that insurance policy has been affected, and every single one of those people are going to be putting in their claim. So no matter how we look at these insurances within the crypto space, there is constant systematic risk. And if there's systematic risk, that means that when something goes wrong, it goes wrong for everybody. If it goes wrong for everybody, everybody puts in their claims, and that is what destroys insurance companies. For example, let's look at Iron Finance. About 2 months ago, there was a project out there, Iron Finance. Even Mark Cuban was invested in it. In Iron, they had their own stablecoin that was also an algorithmic stablecoin. Now, soon after things really got hyped up, people found out that, wait a minute, there was smart contract risk involved because someone was able to actually exploit how the stablecoin works. And anyone that held a stablecoin got absolutely rugged on. Stablecoin was worth fractions of a penny. Now think about this for a second. If there was an insurance company for that stablecoin and people bought that insurance, what would have happened? Their insurance company would have gone bust right off the bat. That's an important thing to remember here, that just because there's insurance does not mean that the money is guaranteed. There's almost like a little meme here where the insurance company almost needs to have insurance themselves because they can't afford to pay out claims that just come in one shot. I suppose the point that I'm getting to is that it makes more sense not to get insurance because if you do get insurance, you are lowering your returns within the DeFi space. And the DeFi space is already extremely risky in terms of how quickly your APYs go up and how quickly they go down and whether a project fails. And if you have an additional expense, as in paying for an insurance, that is an expense that I simply do not believe you are going to see value on because everything is so intertwined within the crypto space that if something major fails over here, it typically affects a lot of things over here. And as it stands right now, with all these different insurance companies kind of popping up, everything's so fragmented. It also leads to the idea that many of these insurance companies in the DeFi space are underfunded. And that's something that you should be looking at. You should kind of look and see who is behind this insurance company. Do they have the money? Are they capitalized well enough to pay out on the claims? Because nothing stops 2 or 3 people who put together $2 million come together and say, hey, listen, we can offer insurance on this project. And people run over, give them money, and all of a sudden their bank account starts going up. But even they themselves know that, hey, if the bottom falls out and this project fails, or this stablecoin gets unpegged, or this contract risk over here, we can't afford to pay them out. So that is research you should be doing. And as it stands right now, I do not believe that there is an insurance company within the crypto space that can actually be capitalized enough to be solvent for systematic risk within the crypto space. And crypto has a tremendous level of systematic risk. One last thing I want to touch on. I know people love crypto, people love DeFi because it's unregulated. There's no one to say, no, you can't do this. You don't have to waste time getting licenses. But there's also a downside to that. You want to open up an insurance company outside the DeFi space within what would be called CeFi space. There's a whole bunch of regulations you have to go through, a bunch of licensing, a bunch of capitalization requirements you would need to open up an insurance company. Within the DeFi space, there is none of that. It doesn't stop anyone from opening up whatever project they want, promising whatever they have to promise without anyone checking up on them. And that's always very important to remember because people sometimes take principles and how things work in the CeFi space and they apply it in the DeFi space and they think everything is gravy, right? They think, well, if there's an insurance policy in the DeFi space, then I'm basically guaranteed to get this money back. And if not, well, I'm going to go and I'm going to take them to court. They broke the contract. Sure, they broke the contract, but good luck taking them to court. As we know, in many cases, many of the people between many of the projects are not located within the US, not located in sometimes countries that are even following the international law of suing and easily getting in touch with them. So it's incredibly more difficult to rely on these projects, knowing also the fact that they're very likely considerably more underfunded, unregulated compared to the CeFi space. As much as we like to make fun of Main Street, right, or Wall Street, and that these people lose money and the companies go bankrupt, I mean, keep in mind, these are people that go to Ivy League schools. They are well connected. They do work for major companies that have access to major banks that give them loans, that give them bailouts. And even then, we see these companies failing, right? AIG. Guarantee the amount of smart people that work for AIG and how well funded they were, they still required a bailout. But because they're within that CeFi space, they were able to get that bailout. In the DeFi space, you don't have that luxury. And you never really truly know that the people behind that project have the expertise. Do they know? Are they finance majors? Do they have any experience running a financial product? Do they know how to crunch the numbers to understand what it takes to be solvent? So these are all questions you should be asking yourself when you are buying an insurance policy within the DeFi space. But as for me, I'm going to continue investing. I'm going to continue trying to save money some here and there within the DeFi space because I find it interesting. And that's what this YouTube channel is about. It's about making returns within the DeFi space, but I also want to be realistic about what to expect uh, in crypto because there's a lot of pumping going on. People think that we're always going to the moon. People think there's only upside. People think that unregulation is the best. But I kind of want to poke holes here or there in some of my videos and explain why sometimes you have to take a step back and look at things a bit more clearly and understand that there's downsides to the unregulated markets. And that is where you yourself have to do your own due diligence, better understand the risks. Now, if you like this video, if you have any comments or maybe rebuttals, please share them in the comments below. I would also greatly appreciate a thumbs up, a subscribe. This is my brand new channel. I just got a mic actually. My previous two videos were very bad in terms of audio quality. So again, if you like this video, just let me know. I would appreciate it. And till next time.